Hey everyone, how's it going? Welcome to Teladoc Health third quarter report. We are here to talk about it. How y'all doing? My name is Emil Hilson. What's going on with all of you guys? And are you guys all an investor in Teladoc? You know, this is a telehealth company in America and they are really big in the healthcare industry. You know, some people say that they're going to be the long-term winners, and right now I'm actually not invested in Teladoc. Okay, I am actually invested in another healthcare company within Canada, but I just love to see Teladoc's performance today in the latest quarterly report. I want to see how well they do, and that's really about it. So all of you in here, what's going on? Are you guys an investor? Let me know your situation as well. What do you guys expect from the numbers as well? Look at that. The amount of coverage this company has is crazy. Okay? Look at that. 20 something analysts. That's like a huge company. Alright? And it's only about 20 something million and you have that much analysts. It's crazy. That shows to you the amount of potential this company has. Or not. And as you know, Kathy Wood, I think in her latest quarterly report, she said that, she said in the latest ARK Invest, she still has it as number 2, right? I just want to make sure. Where's the summary as well? There it is. Top 10 holdings, top 10. Number 3 spot is Teladoc. Okay, Teladoc number 3. And look at Coinbase, how quickly Coinbase has become their second holding. And Teladoc, I think they are going to represent the future in a way. I like their business model and I like healthcare in general as well. I think healthcare for the next decade is going to grow exponentially, about 20-30% compound growth. And Philip Schmidt, I am a shareholder. Okay, you're a shareholder. Awesome. And what made you want to start investing in Teladoc in a way? You know, what is your idea of investing in healthcare in a way? I truly believe that, you know, with virtual healthcare and with other healthcare services, it's gonna change the way that we cure people in a way. Like, there's gonna be better efficiency in the system. And what Teladoc is doing, they're leading the way. They're leading the way. And while we wait for third quarter results, let's see what do analysts has to say. Analysts says that they're gonna obviously be not profitable again this quarter and might take a while with their transaction in Livongo, right? That's a really big part of the business. That's what I heard. And let's see how well they're able to manage their losses this quarter. Cause you look at it, it's kind of crazy how this year they are seriously losing a lot of money in a way. And you look at their revenue side, you know, if you're losing that much revenue, if you're losing that much money, you got to be earning a lot more revenue. Okay, expected about $2 billion of growth this year at an 84% year-over-year comparison. Next year, 28% as well. So it's a nice revenue growth ahead. This is a big growth company, I would have to say. And usually healthcare aren't, you know. Obviously some pharmaceutical are, but healthcare isn't usually the one. They are the link to Livongo. So how many of you guys think Livongo was the perfect transaction, or would you think they overpaid for that company in a way? I don't quite remember how much they paid, but they did some stock and cash transaction, right? And let me know if you guys think Teladoc will be able to meet expectations. Do you think they will beat earnings and revenue, or just come in close in a way? What do you guys all think? And you see the low and high estimates aren't that big of a difference. It's pretty small difference in a way. Oh, but you look at this. Look at the estimates for earnings in a way. 22 cent minus 22 cents versus 80 cents. That is huge in a way. That shows to you, wow, how hard it is to calculate earnings in a way. But look, it's up 3.7% after hours. What's going on? Has it been released yet? Third quarter results. Nope, not yet. I guess people are buying into it, you know, thinking it's gonna do well. Well, look at that, 4% increase now. I read that they have beat expectations for the last 4 quarters. I see that as well. Look at the price movement, 2% after hours. Seems to have nice some buy action, but we'll see about that, right? They haven't released a quarterly report in a way, and just checking out some of their business lines in a way. Teladoc launches mental health services, telemedicine, digital healthcare. How many of you use Teladoc? Curious, any of you in America that's currently using their services? What do you guys all think about their service? Now, I'm not invested in Teladoc. I'm just saying I like to cover the report because there's a company that I'm invested in that's in Canada that is also very similar to Teladoc. You might have heard about them. They are called Well Health Technologies, the Canadian version of Teladoc in a way. And I feel this company has what it takes to be a leader in healthcare as well. And they're gonna be one of the peers to Teladoc, okay? That's my personal investment, but you guys can, you know, think about that as well. And it's also nice to consider what your peers are doing in the industry as well. You know, if they do well, you'll see my company do well as well. Because there's a lot of overlapping and similar points these two companies share in a way. This is more in Canada and Vancouver, and they're a much smaller company. I think they're only about $1 billion in market cap. And yeah, look at that. 1.3 billion versus Teladoc. It's massive in its own way. Teladoc is a 22 billion. So this company is about 20 times bigger than Well. But I think the growth is going to be coming to Well. With the amount of acquisitions that they've done, they call themselves the Berkshire Hathaway of healthcare. And when I see their continuous acquisitions and all that in businesses, I love what the company is doing. And I hope telehealth could be the same thing in some way. You know, they're going to transform the healthcare industry. Yeah. Here we go. Presentation is out. Presentation is out. Earnings release is out as well. Let's go take a look. Here we go. Third quarter earnings grew 81% year over year to 522 million, updating their 2021 revenue outlook to $2 billion. Their total third quarter visits has reached 3.9 million. That's 37% higher than quarter 3 of last year. Good to see that, you know, a correlation between visits, you know, patient visits and revenue. Significant new agreements with CVS Health to provide Teladoc's health primary 360 service to deliver greater healthcare and engagement. So if CVS is a pharmacy, right? If I want to make sure, is this the right CVS Health? Yeah, they're a pharmacy in some way, so they have a partnership with them. Great job, and they're gonna help out. They're gonna give them even more customers in a way. Teladoc ranked first in customer satisfaction through a US telehealth satisfaction study. Okay, so far so good. You know, 522 million. I think they just beat expectations in some way. Yeah, wow, they reached the highest estimates too. So good job to that. Now let's see what else. Our strong performance in the third quarter reflects our continued success in leading the transformation of healthcare delivery and expanding access for all, said Jason Grovick, the Chief Executive Officer at Teladoc. By using our unique combination of data, analytics, technology, and dedicated healthcare professions, we are driving growth across our business. Philip, the day the doctor will be AI Teladoc will be the first. I'm in Europe and they have bought a company in France. I see. So they have made a lot of international deals as well. That's what's important about the company, right? Frank, is it good news or bad news? Frank, you came in at the right time. It is a nice report so far. We'll see if there's anything concerning. So stay tuned and let's continue reading about it. The third quarter was notable in expanding our relationships with a number of leading health plans with successful launch of our primary 360 service, which reimagines the primary healthcare model and delivers increased access and engagement to members. Okay, you hear these messages? It seems like they're expanding their customer base, their access to all available users, and so far their partnerships with other healthcare companies and pharmacies has been working out fine. Let's take a look at the guidance, what he has to say. As we look ahead to the rest of 2021 and next year, we're confident in our ability to innovate, anticipate, and solve the whole person health needs for consumer and healthcare globally. Okay, not too much new information, honestly. Like, that's what you should really feel and expect out of healthcare. You know, as every year passes by, there should be better evolution in the system. Now, let's take a look at the financial results. Here we go. This latest quarter, access fees revenue in US, $413 million versus 194 last year. Huge, okay? International revenue, 37 million compared to 31 last year, so a 90% growth, not too bad. But their US revenue has gone up 113%, which is huge. And that's, I think, because of the recent partnerships that they've made and also their merger with Livinggo, right? That's really helped them in terms of revenue. Visit fee revenue. Okay, this is important. You want to know how much customer base they're actually getting every quarter and whether it's improving and whether it's increasing the numbers. 59 million, that's an 18% increase compared to last year. International wise, 22%, nice growth there. So I'm liking the international growth in a way. You know, obviously it's not as huge as US, but you love to see how this company expands internationally, right? As they continue to build that international healthcare accessibility for all people. And then basically the revenue growth year over year for visit fee and access fees, quite a lot, 100% for access fees, 18% for total. So far, what do you guys think about the report? Here are the address to listen to them directly. Oh, are they having a conference call right now? I'm just curious. Is it right now? I don't think it is right now, right? Is it actually happening right now? I'm just serious. I'm just curious. Right, and they talked about the Livinggo deal, which is that happened last year as well. Okay, so this was including the Livinggo's transaction. That's what made their revenue so much higher. And where is their latest quarterly conference call? At 4:30, right? 4:30 Eastern time. That's in about 15 minutes. Okay, so let's listen to the call afterwards as well. Okay. And I'll put it in the webcast. Let's put it in here. So let's put it into the chat. If you can put it in the chat, that would be lovely. Please put it in the chat. Love that. Dan, how you going? So far so good, and the stock is down 5%. What the? Oh wow. Well, this is just initial reactions. You'll probably see a good movement upwards tomorrow. But the thing is, I haven't gotten even close to finishing the earnings report. I just started looking at the numbers. Look at other types of revenue. US down 7%, international down. I'm not sure what exactly is other in a way. Maybe they should clarify. Right, this is actually my first time looking at Teladoc's revenue report. And the total revenue, nice 81% increase year over year. Nice job for that. Membership and visit fee only access. Let's check that out. Small growth, in paid memberships. And visit fee, a small growth as well. Is analysts expecting much bigger numbers out of this? Because it's weird, because if you have more paid membership and visit fee, your revenue here should be much if this is low, then this actually should be much lower in a way. So I'm just curious about that. Are they having more reoccurring visits in a way for customers? The music is starting on the conference call. Oh, is that right, huh? Okay, then I guess we should get started listening in about 5 minutes. Is that right? I mean, it's just the music, right? Don't worry about that. Let's take a look at the visits. US visits, nice 40% growth. I like that. You have to see that big growth in healthcare. Not just in virtual visits, but also in-person visits as well. International visits up 19%, making your total visits up 37%. And platform-enabled sessions. Is this the virtual visits? I don't quite understand. Platform-enabled sessions are unique in where our licensed platform has a facilitated virtual or video conference between care providers. Okay, so it's between doctors and probably the patients as well. Why is that down, I wonder? Shouldn't that be up in a way? Or is there more people going out to visit doctors in a way? Let's see. If visit fee is more up, in-person visits. Where's in-person visits? Do they have do they separate it by in-person and online? Curious about that. But I love this 40% US visit growth. It's great. More people are open to the idea of seeing doctors again, and reaching out to that is pretty good sign. Next one, net loss. Oh right, let's talk about the net loss. That's what they mentioned here. 84.3 million compared to 35.9 last year. And is there any specific reason for it? Okay. This reflects a higher expense associated with Livongo stock awards that continue after the merger. And then there's also some that's products, intangibles, that's kind of normal thing. But you just have to see how much this Livongo and InTouch Health accusations really cost the company in a way. And then there's also a loss on debt of 0.8 and 43.7 million. Let's see, net loss also includes non-cash. So mainly it's this, the stock compensation associated with the Livongo merger, right? That's what made them lost a lot of money in a way. And later on, as an investor, you have to think about how this company is going to get even better at profitability, right? Because you can't lose money forever, man. You can't lose 84 million for the next few years. You gotta at least slow down your losses, okay? Or else you have to do more stock offering. Financial outlook, very important. They provide guidance based on the current market, and given the uncertainty of the virus, our updated guidance is an evolving situation. But we believe our guidance range provide a reasonable performance for this year. So for the next upcoming quarter, what do they expect? Next upcoming quarter, we expect total revenue to be in the range of 536 to 546 million. That's 5% growth year over year. Not year over year, 5% growth quarter over quarter above. And their adjusted EBITDA, this is basically their profitability in some way, minusing tax, to be in a range of 69 to 74 million. I see. And then the net loss to be about 0.73 to be about 73 cents and 53 cents. So you look at it compared to analysts, right? What does analysts have? About the same. But look this. Who is that guy that predicted them to like lose that much money? Who is that guy? Who is that guy? I just want to know. Get out of here, man. Whoever that analyst is. Because that's nowhere close, okay? What the hell are they doing? Anyways, 73 cents to 53 cents, not too bad. But we'll see. I like the growth so far. They also expect that total US paid memberships to be in a range of 52.5 million to 53.5 million members, and visit fee to be approximately 23 to 24 million individuals. So that's actually quite low in amount. Let me check the membership fees this time. What do they have for membership fees? Is that a decline in a way? Sorry, no, this is revenue in some way, but do they talk about their memberships? Right here, US paid membership. So it has a little growth, honestly, just nothing to really like be arrogant about. So they expect it to be about the same next quarter as well, because it's 52.5 this quarter, same thing. And then they expect the visit fee to be approximately 23 to 24 million individuals. Same thing as well, so not much. And I think that's what analysts are probably gonna ask about. Like, is it because people are more comfortable seeing their doctors, their other doctors in some way? What's up with the slow growth ahead? Shouldn't it be much higher? Total visits to be about 3.9 to 4.1 million, and I think that's about the same as what they put down. Yeah, so a little bit of growth, less than 5%, so minimum growth. But I think investors like you guys aren't in here for that minimum growth, right? You guys are here to expect the huge growth year over year. Phillips in cash, $783 million. Let's check that out. So, okay, this is the earnings call. Let's check out the cash. I'll get to the balance sheet right now to see how well they're doing. Whether they can continually lose money at a big rate. They will disrupt. Frank, so bad news all over. Not really. I think it's quite mixed. I love what they did with the international expansions and their revenue part, like their visits. Right here, like US visits and international visits. And that's probably because of their merger deal that helped them a lot. But you have to see, like, besides relying on the merger deal, you have to now grow naturally and organically, right? What is the future growth for this, right? How are you gonna bring more visits in a way? And in terms of the revenue and membership as well, paid membership, how do you have customers be more loyal and getting new customer acquisitions as well? Okay. And then they talked about the full year 2021 guidance. You're right, Philip. You're talking about how Livinggo is important to collect data. That's right. The more data you collect in terms of customers in a way, the better, because your data is worth so much money, honestly. It is. That's what makes Teladoc special and a lot of companies special. Data, right? Data drives revenue. Total revenue to be in a range of $2 billion. Okay, so let's compare that to what they earned last year in a way. So let's see, 2020. So obviously it's much better than 2020. About like a 4 or 5 times, about 2 times increase, I believe. Last year the revenue was $1 billion, right? Let's check out what estimates. Okay. Their guidance is the same as analysts as well. 2 billion, right on line. Okay, not much changes. And their net loss to be about to be between $3.40 to $3.20, okay, for the entire year. Now compare it to analysts, okay, not too bad, $3.30 on average loss, and that's right on par. And who is that person that predicted 4.84? Who is that guy? Who is that guy, man? Yes, like Tesla for full self-driving, like Lemonade in insurance, right? If you know about Lemonade, Microsoft, all those big boy companies, right? They just really rely on data a lot, and that's their business in some way. Yeah. That's why it's worth a million, right? That's why it's worth billions of dollars, billions and trillions of dollars. Data is weapon in a way. All the social media apps and all that, that is as well. And the total US paid memberships to be about the same as well and all that. Total visits to be 14.5 to 14.7. What did they have? Why is that different? This is like 3 point... I'm not sure. What's total visits? I see it here, but this is only about 3.8 million. Oh, right here. So this is the year to date in a way. So a nice growth, 3.8 million, and they expect it to grow about 4 million next upcoming quarter. An okay growth. Good to know. Now let's actually get to the balance sheet. I want to talk about that. And yes, we're gonna get to talk about the balance sheet, and then we're gonna go move on to the earnings call while looking at the presentations as well. Cash, $823 million. Right? Is that in millions? 823 million, and making their total assets about 17 billion. Okay. What about their liabilities? Current liabilities, 300 million. Okay, they have a lot of cash to pay off that. Easy. I like that. I like that as an investor. You should feel comfortable knowing that. And then you look at, let's see what else. Stock equity holdings, especially related to Livongo. Deficit, okay. Senior notes, that's probably more long-term debt in a way. 1.2 billion. So actually, like, this company financially, they're all right. You know, currently they're doing pretty well. They can cover all their current liabilities, and they don't really have that much long-term debt. You know, I think in the end they'll be able to really pay it off easily, slowly. But I do worry about their net loss, which I'm going to get to in a few seconds. Next, let's take a look at the financials for the revenue. 520 million. Their advertising costs as well. Okay, so the cost of revenue is 169 million. That's a big part. Advertising, wow, that's huge. They've doubled their advertising costs in a way. And anytime you double your advertising costs, you would expect a good amount in your revenue growth. And I think that's a pretty reasonable amount. You know, you spent a double and your revenue is almost doubling as well. You know, sometimes it's not always that 1-to-1 ratio, right? But that shows to you how much they're advertising themselves. Sales, that's tripled in costs. Holy, okay. Technology and development. Obviously, this is a capital intensive business, right? You're gonna constantly need more money for this type of system, healthcare system especially. It costs billions of dollars. And other than that, not too much to really worry about. You know, they do have the revenue to back up how much they spent. So even though it looks much bigger, right? Look, 582 million compared to 308, that's almost a double, right? You look at the revenue, it's not too bad. I think it's a pretty good amount with what they spent, right? Do you guys agree? Do you guys think they spent too much expenses, or are you guys cool with the amount that they spent this quarter in a way? Because they almost spent double compared to last year, right? Loss from operation, right? 60 million, sorry. compared to 19 million last year. And obviously this is a company getting huge growth, right? That's what it is. Oh, by the way, let's do this. Self-investor. All right, let's go. Join in. We in here. Who's gonna ask some questions? I just wanna know, who's gonna ask the questions? Are you guys gonna ask the questions or me? Materials, no materials? Oh, you just want us to look at the presentation? You gonna check the broadcast? I am, of course, right now. Right here, Frank. I have it down right here. They have a lot of cash to burn. Feels like they do. They should use it more wisely. That's what I'm thinking, right? That's why if you do spend your marketing and stuff, you have to use your sales, marketing, and advertising much more wisely, right? You're spending almost triple and double, right? Your revenue should go higher, in a way.
Good day and thank you for standing by.
Okay, you guys hear it? Is it too quiet? Let me know.
2021 earnings conference call.
I'll turn up the volume.
All participants are in a listen-only mode. After the speaker's prepared remarks, there will be.
Can I have my money back? Ask them that.
To ask a question during the session, you will need to press star and then the number 1 on your telephone keypad.
Okay, pay attention to the net loss.
Please be advised that today's conference is being recorded.
0.53.
And if you require any further assistance, please press star 0.
Oh, they lost less money than
I would
average.
now like to hand the conference over to your first speaker today.
That's good.
Mr. Patrick Feely, head of the investor.
But I'm worried about their upcoming
Sir,
growth.
Go ahead.
It's quite minimal.
Thank you and good afternoon. Today, after the market closed, we issued a press release announcing our third quarter 2021 financial results.
Yep.
This press release and the accompanying slide presentation are available in the investor relations.
Oh, we got to take a look at the slide together.
Teladochealth.com.
Yeah, let's take a look.
On this call,
to follow
discuss the results are Jason Gorovic, our Chief Executive Officer, and Mala Murthy, our Chief Financial Officer. During this call, we will also provide our fourth quarter and full year 2021 outlook, and our prepared remarks will be followed by a question.
Okay, let's follow it, guys.
Please note that we'll be discussing certain non-GAAP financial measures that we believe are important in evaluating Teladoc Health's performance. Details on the relationship between these non-GAAP.
Now, curious, those of you that are invested in Teladoc, what is your current
thereof can be found in the press
average cost basis, and how big of it is it in your
also,
portfolio, if you don't mind sharing?
Statements made during this call will be forward-looking statements as defined by the Private Securities Litigation
I personally
Reform
think
Act
investing in
of
healthcare
1995.
and making it your top 3 position
subject to risks, uncertainties, and other
is
factors that could cause
it's quite
the
normal,
actual
honestly.
results for Teladoc Health to
It's
differ materially
it depends on
from
the
those
company, but I
expressed or
think it's a
implied
great
on this call.
investment.
For additional
low
information,
risk
please
in a way,
refer to
but
our cautionary statement
good amount of
in
growth.
the press release and our filings with the SEC, all of which are available on our website. I would now like to turn the call over to Jason.
Jason, let's hear the financial
Good
highlights.
afternoon, and thank you for joining us. This afternoon, I'm pleased to report another strong quarter marked by solid financial performance, more care delivered, and deeper member relationships. Today, I also want to highlight 2 areas where we've made meaningful, high-impact progress toward our goal of transforming healthcare.
Okay.
1, becoming the consumer destination of choice for virtual care, and 2, gaining significant commercial traction for our integrated whole-person primary care approach. Consumers and clients are demanding a single integrated virtual healthcare solution that seamlessly takes care of all of their healthcare needs, redefines the care experience,
4%
and
at
leverages data
$150.
to improve care at scale.
Got it. So it's,
During the third quarter, we continued to demonstrate on our unique ability to meet those
you're gonna
demands
average down it?
with a whole-person care
Philip,
approach
it's down
that
to
continues
$30.
to fuel our sustained
It's
growth.
down about 10%. Might be a good
Our
idea.
broad portfolio of capabilities drove excellent
Dan
financial
is 2
results,
to 3%. Nice
producing
thing.
revenue of
Okay, that's a small
$522
position,
million
honestly, in
the
healthcare.
third quarter,
100
an
shares at
increase of
$136. That's a
81%
pretty
over the
good
prior year,
price as well. 136.
including organic revenue growth of 32%.
When do you guys plan to average
which
or buy
excludes
more?
revenue from acquisitions completed over the past 12 months. With our third quarter results and increased visibility to Q4 revenue,
Okay, let's
we're
check out
updating our
third quarter.
full year revenue guidance range to $2.015 to $2.025 billion.
Okay, total revenue.
Representing growth of 85% over the prior year.
Mm-hmm.
While these financial results quantify our ability to deliver on our promises and sustain the success of our work to transform healthcare, validation came in a number of forms. And we're very proud that Teladoc Health has once again been named #1 in consumer
Right here.
satisfaction by J.D. Power.
Okay, right here.
We've always viewed
Highlights.
our outstanding consumer experience as a key differentiator for us, but also as one of the unique ways in which we expand our role.
Do you guys
in
hear the audio
individual
clearly?
healthcare
I just want to make sure everyone can hear it
For
clearly.
example, we find that the Net Promoter Score for someone's first visit is a strong leading indicator of future usage. And a positive initial experience creates
Where is he
stickier
talking?
relationships with our
Like, which
members.
slide is he on right now?
The recognition by J.D. Power is proof positive that we're delivering on our promise to our members. And the strong utilization increases in spite of the waning pandemic.
Utilization,
are the
right here.
results. Our
Right
global network of
So I guess how much
clinicians
you're
provided
using the
3.9
service?
million visits in the quarter, an increase
Yeah,
of
3.9.
37%
Yeah.
over the third quarter of last year.
I try to my best to keep up with
Even
what he's
as
saying.
pandemic restrictions continue to ease and vaccination rates improve, consumers are increasingly relying on Teladoc Health's virtual care. We're now on track to provide more than 14 million visits for the year.
14.
As has been the case all year, the strength in utilization has been driven by growth in visits related to non-infectious diseases and specialty care, as consumers are turning to us for a broader array of conditions. During the third quarter, more than 75% of member visits in the employer and health plan channel were related to non-infectious diseases.
Oh, I didn't get to
versus
see that part in the
approximately
report.
50% in the pre-pandemic period.
That's pretty useful.
Growth in mental health visits in particular continue to outperform
Did they break that
across
down?
the direct-to-consumer, employer, and health plan populations. And B2B mental health visits remain on pace to double this year as compared to fiscal year 2020.
Not really.
While we continue to see lower than
Not really.
typical transmission of infectious diseases across the country due to social distancing and PPE usage, our infectious disease volumes have continued to increase throughout the year. The combination of building momentum in infectious diseases and continued strength in non-infectious disease and mental health volumes gives us great confidence in our outlook for 2021.
Abu Dha,
We have
350
also
shares
made
at $205.
commercial
Is it
progress
time
with
to
our
buy more for
primary
you?
360
Yes or no?
product,
And why?
Which represents a key pillar of our whole person care
All in
strategy.
Tesla and FUV? What's
Primary
FUV?
360 reimagines primary care by delivering a fully integrated virtual solution
Check
of
out
mental and physical health,
360.
leveraging technology and data, bringing together a full care team for the consumer, and connecting into the physical delivery system to get consumers the right care at the right time. Over the last few months, we've signed several new agreements for Primary 360, including 2 notable health plan deals.
Okay.
First, as announced earlier in the quarter by CVS,
CVS?
we signed an agreement
Right
to
here.
bring Primary 360 to Aetna's self-insured employers nationwide, beginning next year. Earlier this month, we also expanded our relationship with Centene to partner on its new Ambetter Virtual First Health Plans on the healthcare exchanges, beginning with 4 states in 2022. Each of these agreements provides members with access to our virtual care team, including a virtual primary care physician of their choosing and care extenders such as nurses, 0 copays for virtual visits, unlimited messaging, integration with our virtual specialties such as dermatology and mental health, and navigation to local in-network providers.
This is not in the earnings report. This is just new
We
information.
expect these partnerships, along with deals signed across our suite of whole person solutions with HCSC and other Blues plans over the past several months, to contribute meaningfully to growth over the next few years as we drive adoption of our whole person virtual care solutions. Another key on-ramp to our full set of products and capabilities is Teladoc's integrated suite of chronic care solutions.
Chronic care.
The number of individuals enrolled in our suite of chronic care solutions grew 31% year over year to 725,000 at the end of the quarter. In the third quarter, we continued to drive growth in multi-program enrollment. 24% of our chronic care members
Here.
are now enrolled in more than one program,
Look at that.
up
3
from
times
8%
increase year over
in
year.
the third quarter of last year. The
Chronic
growth in
care.
chronic care enrollment, combined with the greater number of individuals enrolled in multiple programs, such as members enrolled in both our diabetes and hypertension programs,
Chronic care is such an
resulted
important
in a
field. It's huge.
45% year-over-year increase in the total number of chronic care programs in which our members are enrolled. Before I pass off the call to Mala, I want to provide some initial perspective on our expectations for 2022. As you know, it's not our typical practice to comment on forward outlook at this point in the year.
Yep.
But we
Let's
believe
take a
the
look.
additional color is appropriate given our
Forward
insights
outlook.
at this stage of the selling season and our outlook on consolidated revenue growth for next year. First, we are as confident as ever in our
Let's see.
multiple levers for growth in 2022 and beyond.
Okay. 2022 beyond.
Our unique ability to deliver longitudinal whole person care is a significant competitive advantage, and our leading position in all B2B and DTC channels enables us to fuel continued growth. Given our insights at this stage of the selling season, our preliminary outlook for consolidated revenue next year is approximately $2.6 billion.
2.6 billion.
We plan to provide additional details around the building blocks to that outlook.
2.6
at our
billion
Investor
compared to
Day in 3
analysts?
weeks. Chronic care is just one of those levers for
Right
growth
on par.
and is
Right
increasingly
online.
converging with others. For example, through the integration of our capabilities into new high-value products like Primary 360 and MyStrength Complete. So far this year, chronic care has grown in line with our initial expectations. However, as we work through the 2022 planning process, we expect to be more conservative.
I'm planning to
about growth
buy. Oh, you're gonna
expectations
buy
for
some long-term
standalone
options
chronic
and
care.
add another 100 shares tomorrow.
Our
Okay.
preliminary outlook assumes standalone
Now,
chronic care revenue.
usually it's a
will
year
grow
or two, right? So are you
approximately
planning to buy a
25
year in or a
35%.
year or 2 years?
And we believe strongly
Very strong
that
in
our
mental
chronic
health.
care capabilities
A patient
will
can
also
call
continue
or
to unlock growth across our integrated
Message
suite of
mental
products and
doctor
solutions.
always. Yeah, I
Our
mean,
whole
obviously,
person
virtual
care
care
approach
is
is
so much more
clearly
convenient,
resonating with
offers
clients and
accessibility for almost
consumers.
everyone.
As their expectations for virtual healthcare delivery continue to move up the value chain and expand from transactional, episodic demand toward integrated longitudinal care. As the only virtual care provider capable of delivering the full credit
It's
answer
the
at
trouble, bro.
scale,
You don't have a clue what
the
you're doing
breadth
or
and
what?
depth of our solution
What do you mean?
uniquely
I'm just
positions
covering
us
the earnings call.
to meet the market's evolving expectations.
I'm not an investor.
And demonstrates
I already said
why
in the
our
beginning, I'm
clients
just covering
are
it
turning
to see what I can
Teladoc
learn from
Health
it.
to satisfy a wider set of consumer healthcare needs. We hope this insight provides helpful context, and we look forward to sharing more at our Investor Day on November 18th, where we plan to provide an update on our progress toward creating the integrated virtual front door to whole person care, as well as detail on our long-term growth outlook.
Guidance.
With that, I'll turn the call over to Mala for a
They didn't talk
review
about
of the
really.
third
They didn't
quarter, as well as
outline it
detailed
in
guidance.
this presentation for
Thank you,
next year.
Jason.
It would be
and
nice
good
if they did.
afternoon, everyone. During the third quarter, total revenue increased 81% to $522 million,
There it
or
is.
32% excluding acquired revenue. Total U.S. revenue for the quarter was $483 million, representing growth of 89% over the prior year's quarter. Total international revenue of $39 million increased 17% over the prior year. Access fee revenue for the third quarter increased 99% year over year to $452 million and represented 87% of total revenue, up from 78% in the prior year's quarter. The increase in access fee revenue as a percentage of total revenue is primarily due to the acquisition of Livongo and growth in direct-to-consumer mental health, which is sold on a subscription basis. Visit fee revenue for the third quarter of $60 million increased 18% year over year. Turning to membership and access, we ended the quarter with U.S. paid membership of 52.5 million members,
Right here.
an increase of 500,000 members
There, now I can follow
sequentially
along.
over the prior quarter. Individuals with visit fee-only access was 23.6 million at the end of the third quarter. Total unique members enrolled in one or more of our chronic care programs was 725,000 members as of the third quarter, a 31% increase over the 553,000 unique members as of the prior year's quarter, pro forma for the merger with Livongo, and an increase of 16,000 members sequentially, which was in line with our expectations. Average revenue per member per month was $2.57 in the third quarter, up from $1.18 in the prior year's quarter, and $2.47 in the second quarter of 2021. The primary driver of the sequential increase in revenue per member was growth in direct-to-consumer mental health revenue. Now turning to visits, during the third quarter, we provided 3.9 million visits through our network of clinicians, representing 37% growth over the prior year's quarter. We saw strong growth in both direct-to-consumer visits and visits through our enterprise relationships with health plans and employers on a year-over-year and a sequential basis. Platform-enabled sessions, which represents encounters facilitated by our licensed platform and provided by our clients' own clinicians, were an additional 1 million in the quarter. The annualized utilization rate for our members was 23.7% in the third quarter, a 720 basis point increase over the prior year's quarter,
Good utilization.
and a 210 basis point increase sequentially.
7% is nice.
Adjusted gross profit, which excludes depreciation and amortization of intangibles, increased to $353 million. Adjusted gross margin was 67.6% compared to 63.7% in the third quarter of 2020. The 390 basis point improvement in adjusted gross margin is primarily attributable to the increased mix of subscription fee revenue versus the prior year. Gross profit and adjusted gross profit in the third quarter of 2021 include the benefit of approximately $5.7 million in lower expenses on Livongo devices attributable to
Do you
purchase
see
accounting
this
adjustments
percentage going
related
up
to the
in the
merger.
next 5 years, like to 75%
Adjusted
potentially?
EBITDA was $67.4 million in the third quarter, compared to
Because that's one of
$39.5
their
million in prior
strategy,
year.
right? Strategies to become even more
Adjusted
profitable,
EBITDA
to
in
be
the third
profitable
quarter of
in a way.
2021 includes a benefit of approximately $5.7 million attributable to purchase accounting adjustments mentioned previously.
Or have they
Better than
reached a
expected
limit in
adjusted
terms of
EBITDA in the
gross margin?
quarter was driven in part by a slower ramp in technology and development spending versus plan. We continue to make material investments in technology and data science to deliver on the full promise of whole person care at scale, and we are anticipating a material ramp up in investment in the fourth quarter and into next year. Net loss in the third quarter was $84 million compared to a net loss of $36 million in the same quarter last year. The wider net loss was primarily attributable to increased stock-based compensation and amortization of acquired intangibles. On a per share basis, net loss was 53 cents for the third quarter compared to a net loss of 43 cents in the prior year's quarter. Net loss per share includes stock-based compensation expense of 45 cents, loss and extinguishment of debt of 1 cent, and amortization of acquired intangibles of 28 cents. We ended the quarter with $826 million in cash and short-term investments, while our total recorded debt outstanding as of quarter end was $1.2 billion. Operating cash flow in the quarter was $77 million. Now, turning to forward guidance. For the full year 2021, we now expect revenue to be in the range of $2.015 to $2.025 billion. We expect adjusted EBITDA in 2021 in the range of $260 to $265 million. As discussed previously, we are reinvesting cost synergies back into the business to fuel long-term growth, including the rollout of
Give me all your predictions when you think Teladoc
such as
fully
MyPlan
reaches
Complete and
positive
Primary
net income.
continued integration
In the next
of Livongo,
3 years?
enhancements to our
3,
integrated data
4,
platform,
5?
and
or more?
expansions into new markets. We now expect total visits in 2021 to be between 14.5 and 14.7 million visits, representing growth of 37 to 39% over the prior year. For the fourth quarter of 2021, we expect revenue of $536 to $546 million, representing growth of 40% to 42% over the prior year's quarter. We expect total paid membership in the range of 52.5 to 53.5 million, and anticipate total visits during the fourth quarter of between 3.9 and 4.1 million visits, which represents year-over-year growth of 32 to 39%. We expect fourth quarter adjusted EBITDA to be in the range of $69 to $74 million. With that, I will turn the call back to Jason for closing remarks.
Thanks, Mala. Finally, I'd like to add that in the midst of all the third quarter efforts we just shared, Teladoc Health as a combined company earned certification as a great place to work. As some of you may know, this premier organization evaluates a company's cultural health through both objective measures and employee
2024.
surveys.
Wow,
before
both of you guys,
conferring its
2024. So
designation.
that's about
And we were excited
3
to get
years
this
from now.
positive report card in the wake of fully integrating our teams. As always,
Now the
thank
question
you for
is,
your continued
how do you
interest
think
in
they'll reach
Teladoc Health.
profitability?
We look forward
Is
to
it
sharing
more gross
more
margins,
at our Investor Day
or,
on November 18th.
you know,
And with
somehow
that,
like
we'll open the call for questions.
better accusation
Operator?
deals in a way? What would it take?
Thank you, Jason. As a reminder, to ask a question, you will need to press star and then the number 1 on your telephone keypad.
All right,
To
analyst
withdraw
questions.
your question, just press the pound.
Let me ask, can I get my
Given
money
time
back?
constraints, please limit yourself to 1 question. Thank you. Please stand by while we compile the Q&A roster.
All right,
Our first question comes from the line of Lisa Gill from JP Morgan. Please proceed with your question.
Lisa, I remember Lisa.
Thanks very much, and good afternoon. Jason, I just want to go back to your comments around whole person and that it'll be meaningful over the next few years. So just to understand this a little bit better, can you help me around how to think about virtual primary care versus traditional when we think about both revenue and profit? And when you say meaningful over the next several years, is that a meaningful driver in 2022?
Yeah, so thanks, Lisa. I'm really excited about our whole person suite of capabilities. And let me go sort of first with what we mean by whole person, and then lean into a deeper discussion of Primary 360. So when we talk about whole person, we mean the philosophy of taking care of the entire person, both their physical health and their mental health, their acute episodic needs, as well as their chronic and complex needs, as well as taking care of them on a preventive basis. Things like making sure that they're getting their screenings, making sure that they're eating properly and have the counsel of a registered dietitian in our nutrition programs, and that they have both digital and human interactions. So a model that brings digital modules to them when that's appropriate, as well as a full care team that's there for them. And we've proven our ability to do that, and the appeal of that with people, the number of people who are now enrolled in multiple chronic care condition
Chronic care is
programs
huge.
for us, as
Huge
well
for
as
their
our
company.
ability to sell mental
Big driver
and
for them
physical
as well.
health together. And we continue to see very, very strong
Like
results
diabetes in a way.
multi-product sales into our
Cancer.
clients. And so what we see is that whole person approach really resonates with the market, both with clients at the purchasing level, as well as with consumers at the utilization level. As I go deeper into Primary 360, we're very excited to have announced relationships with CVS.
So they want to merge with
for their
Google.
Aetna,
Frank, you're
self-insured
hilarious.
clients and virtual first plan designs that we'll be rolling out.
I don't
in that
think you're
market
bag-holding this crap of a
nationally,
company. I think they are a great
as well
company.
as with
I have to
Centene
admit,
and their Ambetter program.
they are. What they're doing
on
for
the,
society?
the exchanges.
We need a
again,
company like
with,
this in society.
With a virtual
To help
first
so
plan
much
design. The
patients
economics
that are in need
are
of
greater
healthcare accessibility
than
and
our
all,
traditional
making life easier for them.
general medical programs or the combination of a general medical and mental health program, because we're bringing the full credit answer, so to speak, to bear for the consumer that takes advantage of our entire
By the way, if you haven't already,
suite of capabilities.
like the video,
when we
it'll
talk
help out a lot
about
with the
meaningful
algorithm.
impact,
Love it if
we
you guys can
expect
give me
to
that
see,
interaction. It means a lot to me.
substantial growth
So thank you
off
very
of,
much to all of
an
you that are
admittedly
watching as
small
well.
base,
Thanks for listening in.
22. And in 23 and beyond, we expect that to have a meaningful impact on our overall financials as a company. And maybe last, before I hand it to Mala for any additional commentary, I'll just preview that we're going to do a deeper dive into our primary 360 product, as well as the opportunity for us to enter into more value-based arrangements to capture a bigger part of the savings that we generate when we host our Investor Day in 3 weeks.
Yeah, and
I was going to save that question for the analyst day, Jason. But Mala, if you want to comment at all from a value-based perspective, just listening to everything that you just said and thinking about value-based programs that are out there, thinking about capitation, this all sounds like this is very well suited as we think about some of those new programs that are coming to the market. So, Mala, if you can add any commentary around the financial impact, but I'm just curious, Jason, do you see Teladoc taking risk in this area? And maybe that's something you're going to talk about at the Analyst Day.
Good question. Holy shit.
Taking risk, and I think we'll step into that. And I'm thinking of a slide that we're going to show at our Investor Day that demonstrates the degrees of risk and the progress that we'll make going from first clinical measures to then risk corridors to ultimately full capitation. Of course, you have to draw a box around that to make sure that we're taking credit for the savings we're generating where we're generating it, and we're not taking risk outside the scope of where we can have an impact. So I think you'll see a lot more depth on that at our Analyst Day.
Yeah, and I would add to the point Jason just made, the fact that we have the data and the data science capabilities that we have.
What Philip mentioned, data.
And the integrated
Data's
data
power.
That we are hard at work on. All of those types of capabilities, along with the scale of technology that we have, is what we will bring to bear as we, go on this journey in expanding Primary 360. The only other thing I wanted to say, Lisa, and again, we'll talk more about this and other sort of levers of growth on Investor Day. As we think about the opportunity for us to penetrate deeper into our member base and think about revenue per member expansion, we are excited about Primary 360 as one of the many levers we have to expand our revenue per member. Again, I still go back to what Jason said. We expect this to be a multi-year journey, with meaningful increase in the 3 to 4 years ahead.
All right, in France we have a medical.
Next question comes from the line
doctor.
of Sean Wayland from Piper Sandler.
I want to talk with you guys, but
Please
I'll wait for the analyst to finish
Thanks
talking.
very much. I wanted to ask about some of the changing privacy landscapes out there, limiting apps' ability to track us all over the place.
We're talking about
What
Apple's iOS
impact
privacy
do you think this
setting.
will have in your DTC marketing strategy and marketing costs?
Sean, I don't think that'll have an impact at all. One of the things that I'm really
Because Apple
proud of
just killed
relative
Snapchat
to our,
with what they did.
DTC
And then
efforts
Facebook just
is,
reported last
one,
week, a few days ago, right?
Focus on
How the
privacy,
ad revenue went down.
and compliance. But number two, also our focus on
Samuel, how you doing?
diversifying
Teladoc is not dying,
channels,
even though total visits are
through
down.
which
I don't think so.
We acquire new members and attract new members.
They're still growing.
And I know that there are.
They got to figure out more ways to get more
companies who are
customers in a way,
very
right?
focused, on one or two channels.
You have to believe in the company and what they're
We've
doing.
done an excellent job over the last several years of diversifying into multiple channels. and always doing it in a way that focuses on sort of the member first. So I don't think it'll have an impact at all, Sean.
Thank you. Your next question comes from the line of Jailendra Singh from Credit Suisse. Please proceed with your question.
Yeah, thanks, and hello, everyone. Jason, I wanted to follow up on your 25 to 35% standalone chronic care revenue growth commentary for next year. I know it is difficult to parse out, but is that before any synergies you expect from Teladoc Livongo combination? And you also mentioned that you are taking a conservative view there. Can you help us understand what is driving that? Are you taking a conservative view around enrollment and adoption of Livongo offering, or is it more around expectations around multi-products enrollment?
Yeah, so I'll comment on the second part. When we talk about chronic care management and our outlook, we've done a lot of work to make sure that we're very focused on the discipline that we bring and have always brought to our management of the pipeline and our forecasting process. When we look at the chronic care, the pipeline, I sort of break it into the different customer channels. We've, I would say, been very successful in selling into the health plan channel over the course of this year, and our pipeline still looks strong with new opportunities. Many of those opportunities, either the existing sales that we've made or the ones in our pipeline, are the permission and the partnership with the health plan to go sell to their self-insured clients. That takes a couple of years to unlock the full value of it, because you have to go through the renewal cycle and the selling cycle to those self-insured clients. And so, you know, we're trying to be very realistic about the sort of on-ramp of those clients in the health plan segment. With respect to the employer market, that's a market where our products are extremely attractive, and historically we've been very successful at selling into the employer market directly when we sell directly to large employers. That's a market where the benefits managers have, I would say, paused over the course of this year more than we've seen it in the past, and it's really due to COVID and them being focused on the pandemic and return to work. As I talk to our employer sales team, they see that picking up substantially as we get to the end of the year and people are starting to get back to the office, and the benefits managers are starting to think about more of a return to normal. And so they're optimistic as we look into next year's selling cycle. And then there are two channels that I would say are just moving a little more slowly than we had originally anticipated. And again, we want to be conservative in our outlook. The broker channel, we had high expectations, and we're just starting to see that pick up now. It took a while to educate the brokers. You know, we have a large distributed broker network, and it took a little while to educate them on a product set that they really didn't have access to before. We're now starting to see that pick up substantially, and we're excited about next year's selling season for that. And then lastly, international. I think the international markets, we have to go through some both regulatory hurdles in terms of local certifications and approvals, but also localizing our products to various international markets, and we're doing that in a fairly methodical approach, market by market. So I think we will see growth internationally, but we don't have really anything in our plan for next year on a substantial basis. And then maybe the last thing I'll say is that's been, I would say, positively offset by our growth in the hospital and health system market, where we've noted before that we've seen especially risk-bearing hospitals really lean into the chronic care solutions, and that's going better than we had expected. So when you put all of that together and we take a, I would say, critical look at the pipeline in our forecast, that's where we landed on that 25 to 35% outlook. Again, that's a contributor to our overall outlook of approximately $2.6 billion in revenue next year.
Thank you. The next question comes from the line of Stephanie Davis from SVP Leerink. Please proceed with your question.
Hey guys, thank you for taking my question. Congrats on the quarter. I was hoping you could give us a broader view on the new Primary 360 offering and how it ties into the existing health system. Is this something where we could see it tie into your existing hospital solution, or should we think of it as a standalone play that almost competes with the traditional health system?
We see our role, and this has always been the case. We believe that we can transform the healthcare experience and transform how people get care by working with the healthcare system and the physical delivery system and integrating into it. I've been quoted many times as saying I don't think healthcare is ripe for disruption. We actually don't use that word when we talk about what our role is. But rather, we think our role is to work with the physical delivery system to improve the care that's ultimately delivered. Now, look, we have certain advantages over the physical delivery system. I mean, we have 2 billion data points in our data platform of chronic care measurements from our chronic care tools. We're delivering over 25,000 personalized health nudges every day. And that's because we have this depth of data. We're providing over 30,000 virtual visits on average every day. So when you put all of that together, we have this incredibly rich set of data. And so we believe that we can really transform the primary care experience and the health outcomes from primary care. But we also recognize that we can't do everything. There's care that has to be delivered in person, and that comes in a number of forms. We'll integrate with certain partners for the last mile delivery, whether that's in-home lab testing or in-home care that can be done in the home but needs a physical interaction, or referring into the most efficient parts of the delivery system. And Stephanie, to your exact question, I think the places where that will happen most seamlessly is the providers who are using our technology platform because we can make a seamless handoff to them and really act like a concierge for the consumer. But we also recognize that we have to be responsive to our health plan partners and refer into the most efficient parts of their delivery network. So I'm not looking to compete with it. I really think that there's an opportunity for us to improve the overall performance of the healthcare system and work with the healthcare system.
And the other thing I would also add, Stephanie, is we are beginning to open the door to conversations with health system leaders around creating virtual front doors within their markets. So it's health plans, as Jason talked about. It's also around health systems. You know the role that primary care plays within their ecosystem, and this is where our Primary 360 product can also be relevant.
Thank you. The next question comes from the line of Richard Close with Canaccord. Please proceed with your question.
Yeah, thank you. Jason, I was wondering if you could give us an update on MyStrength Complete that I think you rolled out here recently over the last quarter. So just an update there. I didn't hear anything in your comments.
Yeah, we're really excited about MyStrength Complete. So, Richard, you know this, but just to recap, MyStrength Complete really brings together the mental health assets of Livongo and Teladoc to deliver a true stepped care model where we bring digital solutions that enable digital modules for the consumer around things like cognitive behavioral therapy and dialectical behavioral therapy and mindfulness and other skills, combined with the legacy Livongo coaches and the network of PhD psychologists and master's level social worker therapists and psychiatrists from Teladoc into really the full continuum of care on the mental health front. We're excited about how the pipeline is building. I think we mentioned that we had made several sales even before the product was launched in the market. The pipeline is showing continued momentum, up strong double digits in terms of a percentage quarter over quarter, and contributing to our overall outlook as we look into next year. I think the other thing I would just say is I expect MyStrength Complete to really complement the rest of our other sort of physical health products. So we're very excited about it, seeing good momentum in the market, and it's also a product that we're just beginning the rollout of internationally. So I don't think that will be limited to the U.S.
The next question comes from the line of Ryan Daniels from William Blair. Please go ahead.
Yeah, great. Thank you for taking the questions. Jason, this is something you're asked probably every 2 to 3 quarters, and I want to give you another shot at this. But I'm curious what you're seeing more broadly in the competitive environment, in particular, with some of the on-site health clinics starting to offer more telehealth solutions and a lot of coalescence around digital healthcare with entities like the patient navigation companies that are integrating things like second opinion services and telehealth and trying to sell that through brokers directly to employers. So can you provide a little bit of a state of a union, if you will, on what you're seeing in the competitive landscape, as it sounds like your win rate and retention remains very strong? Thanks.
Yeah, thanks, Ryan. Maybe I'll start with the last point you made and just confirm that. Our win rates are staying very similar to prior years. So as we look at sort of doing the pipeline review now and where our win rates are, we're staying very similar to where we were in prior years, in spite of the fact that everyone knows there's been a lot of investment in the space. Second, our retention rates are extremely strong. And third, we're seeing really good multi-product sales. So 70% of our bookings this year were multi-product sales as compared to about 50% last year, which I think really gets to the reason that we're winning, right? We're winning because of the full suite of our products and services. And, the truth is that the point solutions, I would say, are really struggling at this point. And if you look at our late-stage pipeline, it's nearly double versus the size of what it was last year. And, I look at all the various players in the market. I wouldn't probably want to be an on-site sort of work site clinic provider at this point, since a lot of companies are talking about going virtual. And so, that has its limitations. Similarly, when I look at the navigation companies, I would say honestly, having been a health plan president, the administrative side of that is fairly low value. I really want to, and we have always focused on making a big clinical impact using our data and our clinical expertise to improve the health of consumers and really focus on the healthcare and not the administrative portion. As I said, I do think we will play a big role, especially with our Primary 360, in helping to get the consumer to the best site of care based on who the most efficient provider is in their local geography. And we can do that in a way that is untethered, because we don't have financial incentive to refer to any specific provider in the market, which is not the case for a lot of the sort of hybrid models that are out there. So I think we can be really pure to our mission of improving care and reducing the cost of care. And then last thing I'd say is, and there was a recent conference where the team that came back said that the big sentiment there was pretty anti-payer in the conference, and a lot of the earlier stage companies were very anti-payer. And we recognize the role of the payer in the market, and we really want to partner with the payers and the employers to bring the best care to the consumer. It's always been our position in the market. And again, we think we're uniquely positioned to do that in partnership with the delivery system rather than antagonistically.
The next question comes from the line of Charles Lee from Cowen. Please proceed with your question.
Hey guys, this is Gwen Shi on for Charles. When talking about your DTC mental health offering, even though we know that an average subscription might be, say, 3 or 4 months long, how often does someone come back and say they start a new subscription later on? So, in other words, even if we're seeing higher customer acquisition costs, are you seeing a level of customer retention such that you don't necessarily have to spend the CAC each time to gain that same user back? Thanks.
Yeah, so I'll start. I'm incredibly proud of our DTC team and the progress they've made. First, they've done a tremendous job based on some of the comments I made earlier about diversification and optimization around our customer acquisition costs. And the team is constantly testing new, more efficient models and then rolling out those models on the customer acquisition side. So our cost of customer acquisition has come down very consistently. Second, as we look at our revenue to customer acquisition cost ratio, that's improved substantially over time. And it's because of what I would say, the first thing I mentioned, of course, customer acquisition costs coming down, but also that the team has done a phenomenal job with lifetime value of a member and improving the LTV of a member. They do that, obviously, there are 2 levers for that, of course. One is pricing optimization and continuing to test different models for that. But the other one is to roll out value-added services and retention strategies, such that one example of those is that a consumer can go to a lower cost, lighter version of the product on an interim basis, sort of as they're in a better place in their lives or not going to lean into as much active therapy over a period of time, but it keeps them engaged with the platform and getting some level of mental health care and support such that they can reignite a more intensive therapy period and, of course, at a higher price at some later date. We've also rolled out things like groupinars and worksheets that a consumer can use in order to track their own progress and work on things between interactions. So your point is an excellent point, and I'm glad you asked it because in order to make a business like that continue to improve, you have to be pulling a lot of different levers. And I would say we are very, very good at test, learn, and lastly, when you get to the kind of scale that we have, when you make small improvements, it can have a big impact.
Yeah, and when we say this business is about execution, which it is, that is the things that Jason talked about is what we mean, right? It is test and learn and scale it, and that is what we mean in execution, in terms of execution, and is fueling both the growth that we are seeing as well as the margins that we are seeing in the business.
And we'll spend some time on our mental health programs, both B2B as well as direct to consumer, at our Analyst Day on November 18th.
Thank you. The next question comes from the line of Sean Dodge from RBC Capital Markets. Please proceed with your question.
Yep, thanks. Good afternoon. Maybe staying on BetterHelp. Jason, earlier in the year, you had said that was expected to grow at least 50% this year. And it sounds like from the tone, and I think you even said it directly, that DTC has continued to outperform. Can you give us a progress report or update on how much that business is contributing now, or how much it has outperformed that kind of initial 50% growth expectation you had?
Yeah. So Sean, give us 3 weeks, and we will satisfy all the questions you asked and the curiosity you have around that. But the headline I would say is we are very pleased with the growth of this business. And you're right, the growth expectations we had set out is what you just said, and I would just say at this point that we are very pleased with how this business has grown. Again, as I said, on the revenue, from a revenue growth standpoint, as well as from a margin standpoint, and we will talk to where the business is in terms of scale, and also importantly, how we are thinking about the growth of this business in the future when we get to Investor Day.
The next question comes from the line of Daniel Grosslight from Citigroup. Please proceed with your question.
Hi, guys. Thanks for taking the question. I have a similar question to Ryan on the competitive dynamic, but specifically focused on the virtual first primary care plans that have come out. Seems like every large MCO now has announced a virtual first pilot in some regard. So I'd love to get your thoughts on just the competitive dynamic there with the third-party vendors, but in particular, I'd like to get your thoughts on the potential for managed care organizations to utilize their own provider networks, like what we're seeing with United and what they're doing with their Optum Virtual Care Group, rather than partnering with folks like you guys for your virtual network. Thanks.
Yeah, so I think there are relatively few health plans in the country who have the capability and the owned provider assets that United has with its Optum owned, Optum Care owned providers. And of course, they're rolling out that product in the markets where they own those, substantial number of primary care providers. We believe a virtual first health plan should be a national product and be available, in all geographies. And we've got a great relationship with United, and we have a number of new opportunities in the pipeline right now across United in multiple parts of their business. When it comes to other health plans, quite frankly, we see a benefit to some of the big plans making announcements about virtual first plans because local plans, quite frankly, have to respond. And so we're seeing that as a catalyst for activity, RFP activity with our Primary 360 product, new pipeline opportunities, and a sense of urgency from multiple plans across the country in response to that. We think, quite frankly, because of the breadth of our product portfolio and the scalability of our platform, we'll win more than our fair share of those opportunities. And as we've talked about, those tend to be compelling economics because we play a bigger role with the consumer.
The next question comes from the line of George Hill with Deutsche Bank. Please proceed with your question.
Hey, good afternoon, guys, and thank you for taking the question. I guess, Jason, just as you think about Primary 360, I guess, can you talk about how much of it you think as net new growth versus the ability to grow wallet share within existing clients? And then following on that trend, I know this is probably going to be one of those questions that preempts Analyst Day, but I'd love you to talk for a second about how big you think Teladoc can be inside of the beneficiary wallet share, particularly inside of that employer sponsor spend.
Yeah, so thanks, George. You're right. Some of that we will cover at Investor Day, specifically around sort of the economic opportunity for the full stack of our products and services. When I think about Primary 360, I think the answer is it will be both a driver of net new growth as well as an expansion within existing clients. Obviously, when you talk about somebody like an Aetna, we've had a long-standing relationship with Aetna, for many years and many products. This is an expansion of our role there, and quite frankly, a bigger economic opportunity for us due to that expansion of our role. But I also look at other health plans where we're seeing opportunities, both formal RFPs as well as deep strategic discussions about the role of Primary 360 and virtual first plan designs and their new relationships that we haven't had before. And then lastly, the opportunity that Mala mentioned about bringing Primary 360 to wrap around a hospital is a significant opportunity. I can think of a conversation I had with the CEO of a large academic medical center that is multi-site and multifaceted just 2 weeks ago, and the discussion was about how we can stand up a virtual primary care offering that is essentially the front door to their system and takes care of their patients in a branded way, and we do that almost white labeled for them. So I think we're going to see new opportunities for that product and that capability that's beyond what we can even imagine today.
Your next question comes from the line of Donald Hooker from KeyBanc. Please proceed with your question.
Oh, great. Thank you very much. I was curious about maybe the platform-enabled solutions metric that you share, and I was sort of thinking about that metric in the context of kind of all that I hear about with regards to labor shortages and wage pressures with health systems, and I'm wondering if there's any emerging opportunity to kind of work with providers in that context and around that metric.
Yeah, it's a good question. We did see a significant shift as offices closed and both consumers and providers all of a sudden embraced virtual care in a way that they hadn't previously. And I think that is a sustained opportunity going forward. I talked to CEOs even of tertiary or quaternary facilities who are saying that they expect anywhere from 25 to 50% of visits to be virtual over the long term. And that's something that nobody would have imagined previously. I also think it does have the opportunity to break down physical barriers and enable more mobility of the workforce, to your point about sort of the labor market. However, I just caution that there are state regulatory barriers to doing that, and many of the states have gone back to requiring in-state licensure in order to deliver the care. Now, we of course have always operated in that environment, and so that's not really a barrier for us. But it is something that I've heard a number of hospital system CEOs lament because it limits the reach of their own workforce.
Yeah, I would also add, on the positive though, I think what is also increasingly clear, through as we come out to some extent from on the other side of the pandemic is the platform we have is purpose-built. And, that is differentiated from just having like a Zoom experience, for example. So there is a difference in the platform we have, and that is increasingly helping the conversations that we are having with the C-suite of health systems.
You may recall that we announced a partnership with Microsoft to deeply integrate our provider platform into Microsoft Teams, and we're seeing that drive substantial growth in our pipeline. So we're excited about that, and we think that will have the desired effect.
Your next question comes from the line of Ravi Misra from Berenberg Capital Markets. Please proceed with your question.
Hi, good evening. Thank you for taking the question. So just two for me, both on kind of chronic care. The first one, can you just tease out a little bit on the 25 to 35% chronic care growth, how you think of that in terms of enrollment versus kind of pricing? And then secondly, it's been about almost 2 years since the Livongo Dexcom agreement was announced. Can we get a little bit more color on how that stands today and maybe how you're looking to go forward on that? Thank you.
Yeah, so with respect to the Livongo Dexcom partnership, we expanded that last year as we moved more into testing CGM and being able to apply our data science against the data flow that can come from CGM. We haven't published or publicized the results, but we have seen some good early indicators relative to that. I think CGM will be just another data source for us. Obviously, for certain populations, CGM is more effective than for others, and more cost effective than for others. And so this was really testing the impact of CGM on type 2 diabetics. And so, I think you'll see us continue to test new models along that path. With respect to the makeup of the 25 to 35% growth, we haven't broken that out publicly. I don't think we're going to do that here. You will get a deeper dive into the market for chronic care programs, as well as our expectations for chronic care at our Investor Day.
The next question comes from the line of David Larsen from BTIG. Please proceed with your question.
Hi, the visit volume growth was very good in the quarter, up 37% year over year. Can you provide any color around how much of that came from better health visits, if any? And then also, within your membership right now, what percentage do you think would be eligible for like a primary care, a virtual primary care physician? Is it like 25%, do you think, like the national average? Thanks very much.
Yeah, so with respect to our growth in visit volume, we're really excited about it. And, quite frankly, I think there were a lot of naysayers a year ago wondering if we could continue to grow our visit volume after the really astronomical growth that we saw last year. So we're very, very proud of it. We had growth both on direct-to-consumer and a B2B basis. So we don't break those out, but I will say that we saw substantial growth on both of those fronts. I think it's probably, you can see the data. Our visit revenue was up 18% year over year. And of course, all visit revenue comes really from a B2B channel. So, we're seeing strong growth on both of those fronts. I think the other things that are just sort of worth noting, repeat usage is really strong. We saw repeat usage up 25% year over year in the third quarter. Which I think is a good indicator and sort of is supported by the J.D. Power findings of us as the highest consumer satisfaction. And I think the other thing that's really nice is we're getting substantial increases in multi-service usage from consumers. So I think all of that, and of course, multi-service is really only available to our B2B clients at this point.
And we are also seeing nice growth, very strong growth in specialty visits, including mental health that we talked about in our prepared remarks. We are seeing growth. We have been seeing continued strong growth in non-infectious diseases. What I will also add is in recent months, we have also started seeing a pickup in infectious disease visit volumes. So all of that is fueling our visit volume growth.
Thank you. And this concludes our question and answer session. I will now turn the call back to Jason Gorevic. Please go ahead.
Thanks, everybody. Appreciate your attention and all your questions. We look forward to seeing everybody in 3 weeks on November 18th at our Investor and Analyst Day. Take care.
Thank you, ladies and gentlemen. This concludes concludes our conference call. Thank you for participating. You may now disconnect.
All right, that was good. Wow, a lot of information. Thank you all for staying tuned for all of that. Sorry about just talking over some of the analysts as well. I know you're here for mostly the earnings call, but there's a live preview of it available, I think, in the next few hours as well. So you guys can always rewatch that. Now, overall, what did I learn from this report? Well, obviously, it's quite mixed in a way, but the thing is they are showing some optimistic signs of growth, and very excited about the 360 Health business. That's going to be a big main revenue generator for them. And as well, they emphasize a lot on chronic care, right? Chronic care and mental health. Those are the big areas that they're really focusing on. So thank you all for joining in. All of you that have been joining, Philip, and then we also have Francis, Arya, Abdullah, Samuel, and don't forget to give this video a like and check out some of my other finance videos as well if you're interested. So love to talk more with you guys in the comment section below, or you guys can join into Discord, whatever it may be. My name is Emmy Hilson. Thank you for joining in today, and I hope to see you all very soon. And you, Frank. Okay. So take care, all of you.